And we're live. Awesome. Good afternoon, everyone. Thank you for joining our webinar, our urgent reaction on the autumn budget from yesterday. Certainly glad it's over and we can look at some of the changes that have been proposed and that have now come into effect as well. So just to give a brief introduction, my name's Arj. I'm one of the founders at Taxed and been supporting individuals in the tax space for the last 10 years. Focusing a little bit on the tax and the technology side, and we set up Taxed 4 or 5 years ago to help clients like yourself file their taxes, file their accounts to HMRC and Companies House. I'll pass over to Eamon.
Thanks, Arj, and hi everyone. Thanks for joining. There's probably quite a few things a lot of you have been affected by in the recent budget. I know I have conversations with quite a few of you, as do Joe and Arj. So for those of you who don't know me, Eamon, also one of the founders, started the journey at PwC, and since then have been really just specialized in kind of tax structuring, tax compliance, tax planning, especially for those of you that also have limited companies as well, which we'll touch on. But yeah, that's me. I'll hand over to Joe now as well, and then look forward to cracking on.
Thanks, guys. Yeah, so I'm Joe, and I'm the tax lead. And same as Eamon and Arj, kind of spent 10 years working in practice. As the guys have said, we've probably spoken to a lot of you before, but I moved into the team to support with heavily on the personal tax side and making sure that our clients, some of you guys are efficient, kind of know what you're doing in terms of filing your taxes, and also helping to ensure that our software kind of remains up to date in line with things like big budget changes. So yeah, I think this will be an interesting one today. Looking forward to kind of getting into some of the details.
Perfect. Thanks, Joe. And yeah, lots of changes from a software perspective, so we'll be busy. And just before we jump into the webinar itself, just wanted to let everyone know, feel free to send any questions via the chat. We want this to be interactive, and we have set aside some time for a Q&A at the end, but use the chat. We'll be here to take questions as we go through. And at the same time, we wanted to kind of outline, set the scene a little bit with some of the key changes that have happened yesterday. Now, the key change I think that we're seeing is that fiscal drag, that threshold freeze, which is going to impact pretty much everyone in the UK. And we'll talk a little bit about how that works. And the thresholds have been frozen for years now. So I think when we started our tax careers, the personal allowance, as an example, was set at 12,000, and it's still now only 12,570. So that's a key one. Will impact pretty much every single one of you here. And then we've also got the 2% tax increase on rental income, savings interest, and on any kind of and on like a dividend that you pull from companies or from your shares, etc. And then we've also got changes from an ISA perspective. If you're holding cash in an ISA, the maximum amount that you can input per year will be 12K, and then the rest, 8K, will need to be pushed into a stocks and shares ISA. Now, I think the overall Labour's position of this was to frame it around pushing towards more growth. Now, we all have probably our personal opinions on whether that is the case. But I think one of the positives that we have seen is there were a few rumors that we know that we've spoken to some of our clients about that were not implemented. So some of you were looking at potentially leaving the UK in recent months, looking at the exit taxes, but that's not been implemented. And there's not a strict wealth tax that has been implemented either. Now, there is the council tax surcharge for properties over £2 million that will be coming into play, but not strictly a wealth tax. For those of you in a partnership, there's no national insurance on partnership profits. You'd be glad to hear. And then separately, there is the employment tax. There is not the employment tax increase. Perfect. So we'll now jump into a little bit around how what some of these changes mean, like fiscal drag, and what you can do to potentially look at working against some of those things and save on your taxes. So I'll pass over to Joe just to cover off a little bit about fiscal drag.
Sounds good. Yeah, so fiscal drag is kind of a topic that I think we've probably heard a lot about recently. It's a popular one, and probably most of us kind of got an idea of it, but we'll just talk about it a little bit just to kind of put it into context and why. I think in the media there's a lot of negativity about the freeze, right? So as Arj said, the personal allowance and the rate bands were frozen by the Tory government, I believe, like back in 2020. And from my perspective, anyway, it felt like every budget the freeze was being extended. Now the freeze was due to come to an end in 2027. The idea being that really personal allowances and rate bands should be and were for a period of time going up, at least somewhat in line with inflation. But it's been frozen. And I think as of 2027, people like myself are starting to think, oh, finally, they might kind of increase the personal allowance, for example, to something like £15,000, which would be handy for a lot of people. However, obviously, they kind of decided to freeze that until 2030. And effectively, what that does is over time, it's going to bring in a hell of a lot of people kind of potentially into what we would say most of the time is going to be like the 40% bracket. So I think probably a lot of people understand right now that £50,000 as a salary perhaps isn't what it was 10 years ago, but you're still looking at the same rate bands and the same personal allowance. And another way to kind of think about this is if you can imagine the personal allowance in 1980, I believe the personal allowance was something around £1,300. The first £1,300 was tax-free, and that was obviously because salaries and wages, etc., were lower. If you could imagine, this is obviously an extreme example, but if you could imagine that the personal allowance hadn't changed since then, you can kind of start to feel how you'd be much worse off from a tax perspective, because bills have gone up, costs have gone up, salaries have gone up somewhat. But if you're still paying tax on everything above £1,300, then you're going to be paying a lot of tax. And that's effectively what's happening here, where employers pay employees more money basically on a yearly or every couple of years. They would kind of give increases, partly for obviously good performance, but also, you know, it's very common in kind of big organizations to see a 3-4% pay rise every year. That's to account for inflation. If the rate bands are not going up with that, what's happening is people's salaries are being pushed up to above 50, 60, 70,000 pounds, and a whole chunk of their income's being taxed at 40%, when had the rate bands gone up, then perhaps they would still be 20% taxpayers, and they should be. I think we looked at this a few months back, and don't quote me on these figures, but in line with inflation, the personal allowance should be something like £16,000 or £17,000. And I think the basic rate band should be upwards of 60, which would mean that a lot of people could earn, you know, up to about £70,000 before paying 20% tax. That hasn't happened. It's been frozen. It's going to draw a lot of people into paying higher tax rates. The other thing here that is worth mentioning is that you might lose out when your kind of salary goes up within inflation, and they're not making other changes to things like marriage allowance and there's a savings allowance. So you get a £1,000 allowance on interest that you don't pay tax on. If you earn over the 20% threshold of 50,270, that's going to drop to £500. Likewise, if you earn a bit more than that, you might lose out completely on the savings allowance because there's been no changes to those things. So that's another example of how you kind of, with the fiscal drag, you're kind of losing out on other things. So that's a bit about fiscal drag, because it's very relevant to this budget. We've got a slide on tax traps, which kind of alludes to some of this. And the tax traps that we talk about are also kind of very popular. But there are scenarios where you could be worse off from an inflation-based salary increase. So if you've got an example here, right? I know not everybody will kind of earn these figures, but a lot of people will. And if you're earning around 98k and your employer is going to kind of sort of give you that annual increase to £104,000, you could be worse off. You could lose out on childcare vouchers, and you're going to lose out on some of your personal allowance because your personal allowance tapers down. And I think we've looked at this in the past, and we've sort of said that in order to actually be better off, especially if you're receiving childcare vouchers, when you're going from 98k into the 100,000, the tax trap, the 60% that we call it, you kind of need to be earning probably in excess of 108k to actually come out of the other side of it and potentially be better off. It's all dependent on your circumstances and whatnot, but it feeds into that idea of salaries going up, but rates, thresholds all staying the same and just like sucking people in, basically. So what you can do, right, and we're going to talk about salary sacrifice and the changes, is, but there are some options here to kind of mitigate as far as you can. The salary sacrifice is going to change, and I'll talk about those changes. But in terms of kind of helping you to avoid potentially those higher tax rates and tax relief, we talk about this a lot on other webinars, but you can currently salary sacrifice and contribute to a pension, which I'm sure probably a lot of you are doing. So if you are around that 100k mark and you're about to go above it, putting in more money into your pensions could help keep you below the 100k, which is going to have that effect of keeping your personal allowance, potentially other benefits that you're kind of entitled to. So that is kind of something to consider, and it might be more relevant now for the next few years, because from April 2029, HMRC are going to, from my perspective anyway, completely restructure the salary sacrifice mechanism, at least for pension contributions, because effectively now, if your employer offers a salary sacrifice scheme, you can kind of, in line with not paying excess pension contributions, you can sacrifice as much of your salary as you want within the realms of what is logical and realistic, and that literally kind of reduces your salary and what you're taxed on. So if you earn 80 and you sacrifice 10, you're actually what goes on your P60 is £70,000. So HMRC are going to change that, and they're going to put a cap on it, and it's going to be up to 2k of your salary will be able to be sacrificed. And the reason for that really is to target national insurance contributions. They're not kind of saying it explicitly, because the reason is that you would still be able to obtain tax relief on your pensions. Right now, a lot of people would need to claim additional tax relief on their pensions through self-assessment. We expect that there may be another way of doing this at the time, but the tax relief for pension contributions will remain. But when you basically go through a self-assessment and claim additional relief on your pensions, there will be no reconciliation on your national insurance position. So the national insurance will come out of your pay, basically, beyond that 2k for people that are contributing above £2,000 out of their salary. So that kind of means that you've kind of got a few years now really where people can maximize potentially if they want to, and I would advise that it's done strategically by looking at everything else and potentially on a call with us. But you may want to think about maximizing salary sacrifice to kind of save on national insurance really before that goes out of the window in 2029. So that's kind of a summary of salary sacrifice and obviously what some of the other concepts mean. I think, is it over to Eamon now to talk about the limited company side of things?
Perfect. Thanks, Joe. And I guess just before I go into like kind of limited company, etc., I guess the main area of conversation right now for me is landlord specifically. And I know that we serve so many of you guys who own property. Of course, a lot of you are actually based overseas, Europe and further afield. And of course, also a lot of you based here in the UK. And I think something we've seen right over the last, I guess, couple of years, even since the mortgage relief changes in terms of capping that deduction, is that landlords seem to be continuously targeted in these budgets, targeted by governments, and are being hit year after year. So we're having to see, well, we're making a lot of changes now in terms of structuring and tax planning, etc., moving forward. Now, as Arj mentioned at the very start of this webinar, one of the main hits is obviously there's now an increase by 2 basis points, 2% up on taxes that landlords are going to pay. This is on top of obviously things like the renters' rights bills we've seen recently, and then the continuous changes to CGT, etc. So I guess what we look at the moment with the landlords that we look after is the overall picture you guys are sat in, because for those of you who are, working here in the UK and have salary from employment, you probably already know that it's pretty beneficial and more efficient for you to incorporate a limited company, especially for any future purchases. For those of you who are based overseas, it could depend. It could depend on where you are physically based and what's the taxation situation in your local jurisdiction. And it can also base on the number of properties you actually own. And that's the same for across the board. So I guess just starting on the basics, which is when you should look to be using a limited company, and then following on from that, how do you actually go about doing that? Well, of course, if you have employment income of £50,000 or more, and as to Joe's point around the fiscal drag, a lot of you over the next year and couple of years to come are going to move into the 40% tax rate if you're not there already. Then any property income you're receiving, your mortgage interest is capped at 20% of the relief. And then obviously your taxation on the profits is 40%. So we've actually seen a lot of people, especially with the interest rates of today, we've actually seen a lot of our landlords who have 1 or 2 properties, the smaller size landlords, move into losses. And that's obviously a position no one wants to be in, but it's the reality of today's situation. And it's obviously a long-term gain property, but in the short term, it's really taking out from the pockets. So moving those properties into a company, if you're buying a new property, then as a lot of you may already know, the property income, you'll be able to take expenses off that a lot more flexibly, including 100% of your mortgage interest. So overall, your profits are going to be lower in a company already, and then you're going to be subject to corporation tax as opposed to personal taxes. So you'll probably find that your kind of tax bill significantly drops within a limited company. So it's a no-brainer for any future purchases to be made through a limited company if you're a high earner. However, a lot of you guys already own property, right? You bought the property in the late 90s, early 2000s, etc., etc. So you had the properties before all these tax changes came in, and now you're kind of, feeling it quite a bit. So in terms of transferring existing properties into a company, and I know we've had some questions on this in the lead up to this webinar, there's a couple of situations. I guess the first one being kind of straight to it is that you are effectively selling that property, right? Right now, the property is owned by you. And if you want to move it into a company, that company is going to be the new owner. So you're effectively making a sale to your own company. So this means that you are going to be subject to another set of stamp duty and potential capital gains, depending on, what that property value is sitting at. So for many people, there is going to be an upfront cost of moving that property into a company. So for example, if someone's got a 200K property and you make that sale, you're probably looking at around 10K in stamp. You have to pay some conveyancing fees to actually get the ownership changed, and maybe some small capital gains. So the upfront cost could be circa 15 grand. So what we would do is look at, okay, through a company, this is how much tax you're going to save year on year. And then we would basically work out what's your break-even point. So for some people, you would pay you would pay, for example, upfront 15K, and you're going to save 5K a year. So 3 years later, you've made your money back, and then after 3 years, you're in pocket. And for some people, they like to do that. For some people, they say, even if it's 7 years, I'll do it because my view is very long term. So we look at that break even and understand exactly what your time frame is going to be. Many of our clients pull out a little bit of equity from one property to then cover the upfront costs of moving their portfolio into a company and then take the ongoing tax savings, right? I guess another point I would mention is that if you own a large number of properties, and you could argue yourself as a professional landlord, as a main kind of business, and you also own those properties with another individual, be that a spouse or a sibling or a close friend, etc., you can then start to potentially walk down the route of making a partnership with those for those properties, and then incorporating that partnership and saying that actually this runs as a business, and therefore you incorporate, and then you can avoid the capital gains and the stamp duties. So a little bit more conditions on that, and that's something we can have separate calls with if anyone has larger portfolios and needs to look into that. But typically, for those of you who own 1 or 2 properties in your own name, you'll have to pay those transfer costs up front. Now, linking that to those of you who are overseas, who are currently obviously not resident of the UK. Now, from a UK perspective, you only have to report your UK source income on your UK tax return. So if you're earning money in, Italy or Dubai or wherever you are, that is completely separate from UK taxation, and you only have to run through the UK rents for taxation purposes. So typically you'll find that actually your taxes maybe aren't as bad. If you've got 1 or 2 properties here in the UK, you may fall into within the £50,000 allowance for 20%, etc. Taxation. Now, what's important to know is if you are a overseas resident, if the property is in a company, then that will not be subject to reporting on your local tax return. So if you are based in Europe or America, etc., and you own a UK limited company, unless you are actually taking salary or dividends from that company, then it will be completely separate for your local return. So as per the question there in the chat, for some of you who may have less efficient taxes where you're based, if you're being taxed on that income quite high, or it's causing too much admin headache, then having it in a company also completely separates it from your local filing. One thing I would say is that if you are overseas, you should always be able to claim a foreign tax credit for any UK taxes you pay. So you're not going to have to be double taxed. You can get relief for any taxes paid in the UK, and your local accountant should be able to do that for you, and you would be able to get that directly from us on your UK return in terms of what you would be giving as your foreign tax credit. So I guess in short, and not to ramble on too much more about landlords specifically, but obviously what this budget has shown is what we've been seeing year after year after year, and it's probably going to continue to a point of where taxes are going to probably raise even more for landlords, is that we should be starting to understand the potential of moving to a limited company. And for a lot of you, it's probably worth even getting in touch with us or looking into it in terms of what actually would your cost be? What would your cost be up front? What is that break-even point going to be? We have a calculator, which I believe we have that up live, but if not, I'll be able to ping something round where you could start to put in some basic figures and see roughly what those charges are going to look like up front and how long it would take you to break even. That might be a starting point to help with that decision. And yes, on the non-resident point, Tom, yes, that would be if a dual tax agreement is in place. UK does have an agreement with most countries, to be honest, that we see all of our clients in. There may be a couple specifically that aren't there, but for most countries we see, there is an agreement, so you would be able to get that foreign tax credit. And if there isn't an agreement, then there's probably even more chance of going into a limited company. So I guess then moving on to the next slide, which isn't just landlords specifically, but it's also freelancers, sole traders, those of you who have got income outside of your employees, who may out of your employment, that may be using limited companies. It's also links all into one, and to a question that we've just had in around how would you actually be able to take the money from a limited company afterwards. So I guess in terms of landlords and property, well, if you buy a property through your company for 200k, for example, a lot of you are going to pay the deposit, the stamp duty, the legal fees up front. Typically, for a 200k property, you're probably going to have about 70 to 75 grand of costs up front. You would be sending that in to the company. So the company is then going to owe you a £75,000. The company has a loan to yourself. So what we often find is when you move to the limited company, and after you pay the corporation tax, which, as we mentioned, is a hell of a lot lower than your personal side, the money you have left in your account, which you send back to yourself, you don't have to report that as personal income, because 99% of the time you're able to write that off against the loan the company has to you. So there's no further taxes, and therefore your cash flow is a lot better. And also it's quicker to increase your portfolio, right? Because more of the money stays in your pocket. Now, for those of you who are who may also be landlords, but also those of you who are self-employed. I know we have a large number of you guys who are self-employed, and those who may be consultants or working through kind of outside of employment. It's also always worth looking at, when is it worth operating through a company set up in this scenario as well. Now, for those of you that are going over the 50,000 mark, it works in a similar way. You're paying 40% taxes in your personal name, but you could move to a company and be subject to corporation tax. Now, you can pay yourself through a kind of £12,500 salary, and then using dividends and pensions to basically increase your net figure in your pocket and reduce your taxes. Pensions specifically is a really good one, because it's also corporation tax and deductible, which is also the same for those of you who are landlords and have property income into a company. You could even bring your tax to zero by making pension contributions directly from the limited company. That will bring your corporation tax down and go into your pension as per normal. You still have the same £60,000 annual allowance in terms of the max contributions you can make. But overall, we are finding that it is going to be more efficient to operate through company structures as we move forward, and who knows what the changes could be in the future. So if those of you who are already self-employed through your own name and doing sole trader accounts, and we did have a question before the webinar around, I'm a self-employed and I make pension contributions to reduce my wages. Am I going to be affected by the changes to national insurance? So a self-employed person, your position won't change if you're making pension contributions through your own name, etc. But it is worth having a look inside of, if you're at that level of earnings, you should be structured through a company. Just to finish off, of course, a little plug to ourselves, but one of the previous drawbacks was that there was very large accountancy fees when it came to structuring and running companies. And that's where myself, Aj, Joe, and all of us have been working so hard to use a combination of our tax platform and our expertise to really bring those fees down and make it more affordable. So the admin and the costs are much less from running a company, and ultimately the goal is that the overall saving is to you guys, the clients' pockets, in terms of your annual tax bill. So that covers a bit on the limited companies. I'm sure there'll be some questions which maybe I'll answer at the end. But for now, Joe, I will hand back over to you, I believe, just to go into the pension side of things a little bit more.
Sounds good. So yeah, we're just going to talk about, there's a few questions popping up around the changes to voluntary national insurance. So for a long time, there's been an opportunity for non-residents to pay either Class 2 or Class 3 national insurance contributions to HMRC on a voluntary basis if you're a non-resident and not otherwise contributing to NI. So for a lot of people, it's been a really good way of keeping up entitlements to the state pension. And actually, Class 2, in the grand scheme of things, very cheap to pay that to HMRC. It's about £179 a year. And effectively, what HMRC have done is they've closed that gap. They've closed that cheap option. So what they're doing is they're saying no more Class 2 for non-residents, basically. What they don't want to do is give, and they've published some guidance on it, but the idea is that for people that don't have or haven't had a long connection to the UK, they don't want to basically give them a cheap option to get a state pension later in life. So the Class 2 option has gone, and there was a few extra requirements to being able to pay for Class 2, and it was mainly around being in work immediately before you left. Class 3, the conditions are basically not as stringent, and Class 3 is still going to be available. Class 3 is quite a bit more expensive, so it normally works at about £900 per year, and HMRC are saying that rather than normally 3 years, then you normally have to have a 3 years in a row, basically, where you were either resident in the UK prior to leaving, or 3 years where you contributed in a row. And they're now saying that window is 10 years. So they're increasing it by quite a large amount. They're basically saying that you either needed to be resident for 10 years in a row, I believe it's 10 years in a row, or contributed for 10 years. And it's just, designed to kind of sort of go after the people that didn't, in their eyes, spend enough time in the UK contributing. So that is quite a big change. I don't think it's one that we saw coming, to be honest, and it kind of went a little bit like under the radar in some respects. But there is still going to be an option to pay voluntary national insurance for people that meet the conditions. It's just going to be tougher conditions based on this 10-year rule, and it's going to be more expensive than Class 2. Class 2 is still available for people who are resident in the UK and are self-employed. So Class 2 is not being scrapped in its entirety. And just having a look at some of these questions as well. The date for scrapping the Class 2 for non-residents is going to be 6th of April, 2026. So we did get some questions coming in before the webinar about kind of doing this now. If you've got approval from HMRC now, or if you go ahead and you get approval before April, you should be okay. You would always need to just check it with HMRC, but I would be completely amazed if HMRC didn't allow any approvals that are going through between now and April. So it will be anything that happens from April. If you're kind of going through this process after April, the rules are going to be different for you. Tom, the rules. The rule, I believe you just need to have any 10-year period. We can check this, but I believe you just need to have a 10-year period in a row where you were resident in the UK. So it doesn't have to be from any specific point, doesn't have to be immediately before you left. I believe it's just any 10-year window where you were constantly resident in the UK. I think that is kind of the main changes they've said there, right, in their guidance, that they've launched a wider review into it. We're not quite sure what they mean by that at this point. I guess there could be further changes. But I guess the key thing probably is that it's going to become potentially quite a lot more expensive for people who are non-resident to contribute and keep up their entitlement to the state pension.
Perfect. Thanks, Joe. In interesting stuff covered across a wide range of areas so far. I guess just a few smaller updates from like a self-assessment and an MTD perspective that I guess were a little bit more hidden. Is actually from an MTD perspective, HMRC will not be applying any kind of penalties to filing late quarterly updates in year one. So for those of you who are sole traders or landlords and you need to file quarterly updates from next April, you don't need to worry in the first year about penalties. Your kind of quarterly updates will be you're free to submit that hopefully on time, but there won't be penalties as you're getting used to the new process. It should be good. And then also for the employees who are filing a self-assessment, the aim is to really add more of that tax bill if you owe HMRC through your self-assessment. And HMRC are looking at doing that within the next couple of years so that more, or if not all, of the tax bill comes through the PAYE scheme instead. Perfect. We've covered a fair amount there with most of the headline updates. Now, there were also changes with regards to venture capital schemes, such as the VCT reduction. But it would be good just to see if there's any questions from the audience at the moment around some of the updates, what it means for you, and we'll see if we will be able to cover some of these questions at the moment.
Perfect.
Comment here just around MTD, no penalty for filing a nil quarterly return on MTD, as long as the final figures are correct. That's good. I would just be careful on that from 2027 onwards, as when they would be expecting the records to be in place, online records, and that would need to be done throughout the year. So not just on the final MTD update, but each quarter ensuring you've got those online records at hand. Got a question here around, I've just returned from being non-resident to be resident this fiscal year in the UK. And yeah, I guess that's an response to another answer.
I guess a question on, because I've seen a few people ask around it, and for a lot of you guys who are non-resident specifically, around the disregarded income and how the mix of property income and savings income could be treated. So it's a little bit of a complex piece of legislation, but to break it down very simply, of course, you could be overseas and you may still have a UK company. So again, to my point around, if those of you who have put your properties into a UK company, then a particular benefit you may have is traditionally you would need to take out that money and write it off against the loan, as mentioned. But if you're overseas, you could pay yourself as a dividend from the company. So all the profits could be paid as a dividend, keeping your loan balance high in the company. And then we have what's known as disregarded income, where any dividends or interest income from the UK, provided you are non-resident and have been or will be for 5 years, then you can get that completely tax-free. So all of the dividends and the interest income could be tax-free, and it's what's known as disregarded from UK taxation. Now, if you are living somewhere like Dubai, that's great because you're not going to be taxed on that in your local country, but you do also have to look at, for those of you who are in Portugal or Italy or wherever that may be, if you are receiving interest income and dividend income, then maybe that will be subject to tax. And it's something we can look at when having those conversations. But to the question around the rate and how it works with, I'll start with how it works with rental income. Because there was also a question from Paul in the chat, if you are to have rental income and dividend interest income from overseas, then you can't just disregard the entire dividend income and then also keep your tax-free allowance on the property income. You have to give that up. So therefore your taxes on the rental income could be higher. So what we do, and the tax software also does it automatically, is we just do a calculation to see what's more efficient. kind of putting your dividend income subject to UK tax and keeping your personal allowance, or losing your personal allowance and exempting the dividend income from taxation. So for those of you who have large amounts of dividend income and interest income and live overseas in a country that doesn't have high taxes, it's a fantastic opportunity. For those of you who have large property income, then you're probably going to continue to pay taxes on the dividends and interest as well. It just comes up to that point around a lot more flexibility with having a company. So to Gary's point, that hopefully explains the disregarded income rule, so only available for non-residents in those situations, and the 2% is an increase on the tax rates, so going to 22, 42 and 47, and it's going to work in exactly the same way right now in terms of ordering of income. So typically how it works in the UK is your employment and your self-employment takes up the starting parts of the tax rates, then you add on rental income, and then savings and dividend income, etc., come after that. So you're probably going to find that your savings and dividend income always fall into that slightly higher bits of taxes. So yeah, that's hopefully covers that area.
Perfect. Got a question here around the 2% additional tax on rental income, and that will also be impacting non-resident landlords. Whether you earn that income gross, so if you filed the NRL1 form with HMRC, you are notifying HMRC that you will file your self-assessment, so they'll pay the income gross. You would then need to file your self-assessment and you'll be taxed from the profits. That profit will be taxed at an additional 2%. Or if you've not filed your NRL1 form, HMRC and your letting agent will automatically deduct now 22% instead of 20%. Great stuff. I think we've covered most of the questions here.
Yeah, we had a couple of questions before the webinar come in, more around CGT and selling of property. So I guess just as a very small comment on that there wasn't any updates to capital gains in the budget yesterday in terms of selling of properties, etc. So still going to fall into those same rates of capital gains, and no changes there, whether you're in the UK or overseas. If you're a non-resident, then you could potentially still use the rebasis method of selling properties. And I know there was quite a few of you who were looking to make some sales. So yeah, no changes there. And I guess any support on CGT, then Joe's obviously helping a lot of landlords at the moment with that.
I think we also had a couple of questions about the rates in Scotland as well. I don't think we've covered that. But basically, at this point, HMRC have just said that they're going to consult with the other devolved countries, basically, and devolved territories. So I'm aware that obviously Scotland has got different rates already for income tax generally. So we don't actually know at this point if the rate changes that we've seen on dividends and interest and rent income are going to apply to Scotland, but it will be something that we will be looking out for HMRC publishing guidance on and kind of let people know.
Perfect. Thanks, John. Perfect. Chris, question. Of course, we can certainly reach out after this webinar and set up a call to chat through with you. And I guess just from everyone's perspective as well, that's what we're here to support with. Although we are a primarily tax software, we do have the tax advisors, accountants, all behind the scenes, ready to support. So if you do have any questions as you go forward, feel free to get in touch with myself or a member of the team. I think that's all the questions that we've got so far. We did get a few more via email, which were kind of detailed. So feel free to send any more through, and we'll be getting back to those questions in the next couple of days. Thanks everyone for watching this webinar. Hopefully a little bit of insight into the autumn budget, how it's impacted yourself and other UK taxpayers. And as we move forward, feel free to get in touch with our team and we'll be here to help.
Great stuff. Thank you, everyone. Thanks a lot.